Summary. Buying your first home could be the biggest financial achievement of your life, and with the time and effort required, you won't want to rush things. Before you start thinking about a mortgage, you should make sure that your finances are in order. You will need to have good control over debt as well as a good amount of savings in your account to be eligible for a loan and cover the cost of the loan. When you're ready to start hunting for a home, you will need a real estate agent to guide you on the process. The real estate agent will check for homes within your mortgage range and help you with negotiations. When you see a home that meets your criteria, you can go ahead and make an offer, have the home inspected, and conduct an appraisal. If everything is successful, you can go ahead to make your down payment and closing costs, then close the loan. How to buy your first home. Owning a home is considered the American dream, but buying your first home could leave you in a train wreck if you do not follow the right steps. As a first-timer, buying a home could be the biggest financial commitment of your life, so you need to put a lot of time and effort into making the best decision, as you could be spending a significant part of your life in your new home. This article guides you by providing the right steps to follow as a first-time homebuyer. They will help you make the right decision when going for a home regardless of your income status. 1. Decide whether you're ready to buy a home. Buying a home is not just a huge financial commitment, it is also an investment that will pay off in the future if you decide to rent or sell the house. So before you start dreaming about what your new home would look like, you should first decide if you're ready to buy a home. This means you need to take a deeper look at your finances. Are you well employed, or are you stable enough to pay off mortgage? You will be required to submit documents on tax returns, recent pay stubs, and other documents depending on your type of employment. You will also need to keep your debt-to-income ratio on the low. The debt-to-income ratio is used to evaluate how much of your monthly income will be used to pay off your mortgage debt. You will need to keep your DTI below 43% to qualify for a good mortgage rate. 2. Check your credit history. Your credit history plays a vital role in determining how good your mortgage rates would be. Lenders use credit scores to determine your ability to pay back. Before you think about buying a home, you should check out your credit history and credit score on credit agencies such as Equifax and TransUnion. There are free credit score websites that could give you an accurate figure as to your credit score. To get the best rate, you should have a credit score of at least 700. Generally, lenders have a minimum credit score requirement of 620. 3. Get pre-qualified and pre-approved. Getting pre-qualified for a loan doesn't increase your chance of getting a mortgage, however, it does give you an idea of what you will be able to qualify for when you apply for a mortgage. When you apply for the pre-qualification, you will be provided with a rough estimate that might not be close to what you will really get when you actually go for a mortgage. Getting pre-qualified won't cost you anything and would take a few minutes. You will only be required to provide basic financial information in this process. Getting pre-approved takes more time, and just like getting pre-qualified, it doesn't guarantee you will get a mortgage. The main differences between both processes are that getting pre-approved requires that you provide all your financial and employment information to the lender, and you could be charged for the process. Getting pre-approved will give you a better estimate of how much you can qualify for. 4. Save for a down payment and closing costs. While your mortgage loan will give you the amount you will need to cover the cost of the house, you will be required to make a down payment based on the value of the house. You will also have to cover the closing costs yourself. Saving for down payment and closing costs shouldn't be a problem, as there are many ways to do so, which also include getting grants from programs willing to help first-time homebuyers. Down payment. The down payment refers to a one-time payment you must make towards the purchase of a home. Your down payment could be 3 or 4 times larger than your closing cost. Your lender will determine how much you will have put down, but you can go higher to reduce your interest rate. The down payment could be 3.5% up to 20%. Your credit score, DTI, and other factors will determine if the down payment will be in your favor. Take note that saving for a larger down payment will give you more mortgage options, a smaller monthly payment, and a lower interest rate. In addition, you won't have to pay for private mortgage insurance, PMI, which could increase the overall cost of the loan. Closing costs. Closing costs refer to the fees you will have to pay to cover the loan. The closing costs could be between 3% to 6% of the home value, though not every loan would require you to pay the closing costs before getting the loan. In fact, you could ask your lender to roll your closing costs into the mortgage. 5. Research for a real estate agent. You won't want to go searching for a home on your own, because the real estate market could turn out to be your worst nightmare. A real estate agent that knows the ins and out of the market will help you purchase the house of your dreams at the right price. You won't have to save up to pay a real estate agent, as the seller will pay the real estate agent a commission, which is usually 3% of the purchase price. A real estate agent will provide you with more information on what to look out for when searching for a home, as well as take you around to show you properties. The real estate agent will also assist in negotiations so you don't get ripped off. As a first-time buyer, a real estate agent is a necessity to make the process less complicated. 6. Start house hunting. With a real estate agent by your side, you can start hunting for houses within your budget. You should make a list of the features you expect in your home. This should include the cost of the home, square footage, access to public transportation, number of bedrooms, backyard space, property/real estate taxes. If you're buying a home so that you can settle down, then you should ensure that your home is close to local schools. You might also want to consider the condition of the home when searching. Homes that require repairs would cost less to purchase, and you won't have to fix all the problems right away to move in. When you start hunting for a home, you should make sure that you take a good look at more than 1 or 2 options. 7. Make an offer. When you've found that dream home, you should make an offer by submitting an offer letter in writing. In your offer letter, you should include details like the price you want to pay for the home, your name, your current address, and a deadline for the seller to respond to the letter. You can get your real estate agent to write the letter for you. The seller can accept the offer, reject the offer, or make you a counteroffer, which could be either changing the purchase price or terms of sale. 8. Perform a home inspection. If you're able to successfully secure the home, then you will have to perform a home inspection. This will cost you some bucks, as you will have to hire a professional inspector to take a look at the home. The inspector will test electrical systems, roofing, and home appliances. They will also check the integrity of the home and provide you with a list of problems that would have to be looked into. When you get the list, check out for serious problems like health hazards and ask the seller to fix them before closing the deal. You might also want to consider moving on to other options rather than waiting for the house to get fixed. Take note that once the deal is settled, or the sale is closed, you will be liable for any major repair. Avoid going for houses with major problems like poor installed windows and cracks in the foundation. 9. Get a home appraisal. A home appraisal will determine the value of the home you want to buy. Lenders will require that you get an appraisal to determine how much you actually need for a loan. You can include an appraisal contingency in your offer to the seller to allow you back out of a purchase or negotiate a lower price if the home appraises for less than the offer amount. 10. Close on your new home. If everything checks out during the appraisal and you are sure that the minor repairs and fixes the home needs are nothing to worry about, you can go ahead to close on the home. Before that, you should check to ensure everything is in order and keep an eye out for pests. Your lender will give you your closing disclosure, which summarizes your loan details and also tell you about your closing costs. This will be provided to you 3 days before closing. You will have to sign a settlement statement, pay your down payment and closing costs, and sign the mortgage note. Finally, you will sign the deed of trust and close the loan. With that, you're officially a homeowner.